Most people in the United Kingdom will spend their entire working life handing over a massive chunk of everything they earn, everything they save, and everything they build straight to HMRC. And then, right at the very end, when they die, HMRC shows up one final time and takes 40% of whatever is left. That is not a conspiracy theory. That is literally just how the tax system works. But here is the thing that nobody tells you. The wealthiest people in this country are not playing the same game as you. They are not earning income and getting taxed on it. They are not selling assets and triggering capital gains tax. They are doing something completely different. Something that is 100% legal, has been used for decades, and that the average person in the street has absolutely no idea about. It is called buy, borrow, die. And by the end of this video, you are going to understand exactly how it works, why it is so powerful, and what you can actually do with this information today. Before we get into it, I just want to be crystal clear about something. Nothing in this video is financial advice. We are here to educate you on how the tax system works so that you can have better conversations with your own accountant or financial advisor. This is about giving you the knowledge that most people never get. Right, let us get into it. So let me start by painting you a picture of the average working person in the United Kingdom. You wake up, you go to work, your employer pays you your salary, but before that money even touches your bank account, HMRC has already taken income tax and national insurance straight off the top. If you are earning between £50,000 and £100,000 a year, you are effectively working from the start of January all the way through to the end of May just to pay your tax bill. Every single pound you earn from January through to roughly the middle of May belongs to the government. You do not see it. You never touch it. It just disappears. And that is before we even talk about what happens when you actually spend your money. When you buy something, VAT takes another 20%. When you fill up your car, fuel duty hits you. When you buy a house, stamp duty land tax is waiting. When you sell an investment property and make a profit, capital gains tax steps in. And then, finally, when you die and try to leave something behind for your kids, inheritance tax charges 40% on your estate above £325,000. That threshold, by the way, has been frozen since 2009. Not a typo, since 2009. And HMRC just confirmed it will stay frozen until at least 2031. So while house prices and asset values have gone up dramatically, the threshold where inheritance tax kicks in has just sat there, completely still, dragging more and more ordinary families into paying a tax that used to only affect the genuinely wealthy. Now here is where it gets interesting. The ultra-wealthy, the people with serious assets, the people who own multiple properties, large investment portfolios, and significant business stakes, they do not operate within this system in the same way. They understand something fundamental about how tax in the United Kingdom actually works. The tax system in this country is almost entirely designed to tax income, not wealth, income. The moment you earn money, you get taxed. The moment you sell something and crystallize a gain, you get taxed. But here is the key insight. Borrowing money is not a taxable event. When you take out a mortgage or a loan against an asset you own, HMRC does not send you a bill, because technically you have not received income. You have received a liability. You owe that money back. And that one simple fact is the foundation of the entire buy, borrow, die strategy. Let me break this down into its three components, because once you see how each piece connects, the whole thing just clicks. The first part is buy. This is about acquiring assets that grow in value over time. In the United Kingdom context, property is the most common example. You buy a property. Maybe it is worth £300,000. Over the next 10, 15, 20 years, that property appreciates. It might be worth £600,000, £700,000. It has doubled or more. The key thing here is that during that entire time, you have not paid a single penny of tax on that growth. You only trigger a tax event if you sell it. And if you never sell it, HMRC never sees that gain. The asset just sits there, growing, untouched by the taxman as long as it stays in your hands. The second part is borrow. This is where the strategy becomes genuinely powerful. Let us say your property has gone up in value and you want to access some of that wealth. You want cash in your pocket. The standard approach for most people is to sell the property. The moment you do that, capital gains tax kicks in. Right now in the United Kingdom, if you are a higher rate taxpayer and you sell a residential investment property, you are paying 24% capital gains tax on the profit. So if you bought a property for £200,000 and you sell it for £500,000, you have made a £300,000 gain. You owe HMRC 24% of that. That is £72,000 gone just like that. And you have to pay it within 60 days of completing the sale. That is brutal. Now here is what a wealthy investor does instead. Instead of selling the property and triggering that capital gains tax bill, they go to a bank and they remortgage the property or take out a secured loan against it. They borrow, say, £150,000 against it. That money lands in their bank account. They can spend it on whatever they want. A new investment, a car, a holiday, living costs, whatever. And HMRC gets absolutely nothing. Because borrowing money is not income, it is debt. You have not sold anything. You have not crystallized any gain. The taxable event has never happened. And here is the really clever part. If you own a rental property, your tenants are essentially paying the interest on that loan for you through their rent. So the cost of borrowing is covered, the cash is in your pocket, and the tax bill is zero. Now some of you might be thinking, okay, but you still owe the bank that money. You still have to pay it back eventually. And yes, that is absolutely true. But here is the thing. Wealthy investors are not planning to pay it back from their own pocket. They are planning to let inflation do the heavy lifting over time. Think about it this way. £150,000 borrowed today is worth a lot more in real terms than £150,000 in 20 years' time. Inflation erodes the real value of debt. Meanwhile, your asset, the property, keeps going up in value. So the debt shrinks in real terms while the asset grows in real terms. It is almost like the system is working in reverse for you compared to how it works for most people. The third part of the strategy is die. And I know that sounds dark, but stay with me because this is where the whole thing becomes a generational wealth machine. In the United Kingdom, when you die and pass on an asset to your beneficiaries, there is something called the uplift in base cost for capital gains tax purposes. What this means is that when your heirs inherit your property or other assets, the capital gains tax on all that historic growth that built up during your lifetime is effectively wiped out. The base cost for capital gains tax purposes resets to the value of the asset at the date of death. So all those decades of appreciation, all that growth that would have triggered a massive capital gains tax bill if you had sold the asset yourself, that liability disappears completely from a capital gains tax perspective. Your children or whoever inherits from you gets the asset at its current value, and capital gains tax is calculated from that point forward if they ever decide to sell. Now obviously you do still have inheritance tax to think about. At 40% above £325,000 and the residence nil rate band of £175,000 on top of that for properties passed to direct descendants, inheritance tax is absolutely a real consideration. But the borrow until you die strategy actually helps reduce your inheritance tax exposure too. Here is why. When you borrow against your assets, those loans are counted as liabilities against your estate. So if your property is worth £1 million but you have £400,000 of mortgages and secured loans against it, HMRC calculates your inheritance tax on the net estate value, which is £600,000, not £1 million. The debt reduces your taxable estate. So by borrowing against your assets throughout your lifetime to release cash without selling and triggering capital gains tax, you are simultaneously reducing the inheritance tax bill that your family will face when you are gone. Let me give you a concrete example to make this crystal clear. Take a property investor. He bought a property 15 years ago for £250,000. It is now worth £600,000. His tenant pays him £1,200 a month in rent. He wants to release some cash. Option 1, he sells the property. He makes a gain of £350,000. After his annual capital gains tax allowance of £3,000, he owes 24% on £347,000. That is over £83,000 in capital gains tax, payable within 60 days. His property is gone. His tenant is gone. His rental income is gone. He hands over £83,000 to HMRC. Option 2, he goes to his lender and remortgages the property. He releases £150,000 in cash. His tenant continues to pay rent, which covers the new interest payments. He pays zero capital gains tax. Zero. HMRC gets nothing. The property continues to appreciate. The loan erodes in real terms over time, and when he eventually dies, his heirs inherit the property at its current market value. The debt is deducted from his estate, and the historic capital gains liability evaporates. That is not a loophole in a grey area. That is how the tax rules are deliberately structured. Borrowing is not income. Death resets the capital gains base cost. Debts reduce the estate for inheritance tax. These are all established parts of UK tax law. This is the game the wealthy have been playing for generations. Now let us talk about why this strategy is not just for multimillionaires, because I think a lot of people hear this and assume it only applies to people with huge property portfolios. But actually, the core principles apply at a much smaller scale too. If you own a home in the United Kingdom that has gone up in value, you already have an appreciating asset. You already have equity that you could potentially borrow against. The strategy does not require you to be rich to start. It requires you to think differently about the relationship between assets, debt, and tax. And the buy, borrow, die framework is not just about property either. It applies to shares and investment portfolios. It applies to business ownership. If you own shares in a company and those shares have grown massively in value, you could potentially borrow against them rather than selling and triggering a capital gains tax bill. The same principle applies. You access the value of the asset without creating a taxable event. Now, here is something really important that I need to address. Some people hear this strategy and think it sounds too good to be true, or they think HMRC must have a way of closing it down. And the honest answer is that HMRC is absolutely aware of this. They know how wealthy people structure their affairs, but they cannot simply make borrowing taxable without completely breaking the entire mortgage market and the wider economy. Every single person in the country who has a mortgage is borrowing against an asset. If borrowing became a taxable event, the housing market would collapse overnight, so the structure fundamentally stays in place. What HMRC does instead is look for people who are deliberately abusing the system in artificial ways, or people who are trying to dodge tax that is legitimately owed. Sensible, well-structured planning using these principles is completely different from tax evasion. Tax avoidance done properly through legitimate planning is legal. Tax evasion, which is hiding income or lying to HMRC, is a criminal offense. The buy, borrow, die strategy falls squarely in the legitimate planning camp. However, and this is really important, HMRC has been making changes that are slowly tightening the edges of this kind of planning. The inheritance tax changes that come into effect from April 2027 are a big one. Pension funds are being brought into the inheritance tax net from that date. So if you are planning to use your pension as a tax-free way to pass wealth to your children, that particular door is being shut. The pension will form part of your estate for inheritance tax purposes from April 2027. That is a massive change, and if you have significant pension savings, you genuinely need to speak to an advisor about the implications for your estate planning before that date arrives. The annual capital gains tax allowance has also been slashed in recent years. It used to be £12,300 per person per year. It is now just £3,000. So the small amount of flexibility individuals used to have to realise gains gradually and stay within their allowance each year has been dramatically reduced. HMRC is tightening the screws. The window for straightforward planning is getting smaller. And the inheritance tax nil rate band, £325,000, frozen since 2009, staying frozen until 2031 at the earliest. In 2009, the average house price in the United Kingdom was around £160,000. Today, it is well over £280,000. More and more estates that were never supposed to be caught by inheritance tax are now caught by it, purely because the threshold has not moved while asset values have. That is fiscal drag in action. HMRC collects more inheritance tax every single year without ever changing the rate. They just keep the threshold frozen and let inflation do the work. So what should you actually do with all of this? Let me give you the practical takeaways. First, if you own property or other appreciating assets, understand that selling is not your only option when you want to access value. Before you sell anything, talk to an advisor about whether borrowing against the asset makes more sense from a tax perspective. In many cases, it will. Second, think about your estate right now, not when you are old. Now, because the planning you do today has a much bigger impact than the panic planning people try to do in the last few years of their life. With the nil rate band frozen and inheritance tax being extended to pensions from 2027, the number of families that are going to get an unexpected inheritance tax bill is going to increase significantly over the next decade. Third, understand the difference between income and capital. HMRC has set the system up to absolutely hammer earned income and to tax the selling of assets. But the growth in value of assets you hold and the money you borrow against them sits outside that system. Wealthy people understand this. They build wealth through assets. They access cash through borrowing. They minimize income. That is the formula. The buy, borrow, die strategy is not some secret scheme that only works for hedge fund managers in Mayfair. It is a framework for understanding how money actually moves through the tax system when you structure things properly. The average person in this country has never been taught this. The school system does not teach it. Most employers do not talk about it. And that is exactly why the gap between people who understand how money works and people who do not keeps getting wider every single generation. What the wealthy figured out a long time ago is that it is not about earning more. It is about keeping more. And keeping more means understanding the rules of the game well enough to stop handing over money to HMRC that you were never legally required to hand over in the first place. That is what this channel is about. Giving you the information that most people only get if they can afford to pay a really good accountant or a private wealth advisor. You deserve to understand how your own tax system works. And now a little bit more of it makes sense. If you found this useful, share it with someone who needs to hear it. There are millions of people in this country silently overpaying tax their entire life simply because nobody ever explained any of this to them. Let us fix that.